Tom is 63 years old. He's been building his SCHD position for 4 years, 900 shares, $400 a month, every single month, through market drops and market surges, through a car repair that wiped out one contribution and a bonus that doubled another. 2 years from now, he plans to retire. And right now, on a Sunday evening, he's sitting at his kitchen table with his brokerage app open. All week, the same headlines. SCHD is being overhauled, energy stocks are getting cut nearly in half, the fund is changing on March 23rd. Tom doesn't fully understand what a reconstitution is. He just knows that he spent 4 years building something, and that the sell button is right there on the screen. By the end of this video, you're going to know exactly what the SCHD 2026 reconstitution actually does to your dividend income, and why the one number that matters most has never gone down in 14 years, not once. But before we get there, there's one number inside this reconstitution story that almost no one is talking about. It's not the yield, it's not the sector weights, and for retirees, it could be quietly worth hundreds of dollars a year. We'll get to it. Quick note before we start, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always work with a qualified professional. Now, let's sit with Tom for a minute, because what he's feeling right now, you may have felt it too. The Sunday evening mistake. Tom built his SCHD position the way most of us do, not all at once. $400 a month, every month for 4 years. He watched the quarterly dividend hit his account like a small but reliable paycheck. This quarter, a little more than last quarter. Last year, more than the year before. It's not a fortune, but it's real. In 2 years when he stops working, he is going to need it to be there. This week, 3 different videos told him energy is getting cut nearly in half. His fund is being overhauled. One headline called it the most dramatic reconstitution in years. So, Tom opens the app, pulls up his 900 shares, and he starts building a sell order. His plan is simple. Sell everything, wait for the dust to settle, and buy back in once things stabilize. He gets to the confirm screen, cursor hovering. If you've ever felt that same pull, that instinct to protect what you've built from something you don't fully understand, you already know exactly where Tom is sitting. That instinct isn't foolish, it's human. The question isn't whether to pay attention to this. The question is whether you're reading it correctly. Because Tom is about to make a mistake, and the reason why is something most investors never see coming. Before Tom hits confirm, there's something he doesn't know yet, and it's going to change everything about how he reads this situation. What the reconstitution actually is. Let's slow down and look at what's actually happening here. SCHD, the Schwab U.S. Dividend Equity ETF, doesn't pick its own stocks. It tracks an index, the Dow Jones U.S. Dividend 100. And every March, that index does an annual review of every company it holds. Here's how it works. The index starts by screening every stock in the U.S. market for companies that have paid dividends for at least 10 consecutive years. Most companies are eliminated immediately. Then it applies a yield gate. Only the top half, ranked by dividend yield, move forward. Then it ranks every surviving company on 4 fundamental factors: cash flow relative to total debt, return on equity, dividend yield, and 5-year dividend growth rate. The top 100 make the final cut. No single sector can represent more than 25% of the fund. This is not a committee making judgment calls. There is no debate in a boardroom. It is a rules-based process, automatic, consistent, and completely transparent. This year, the SCHD 2026 rebalancing is projected to trim energy from roughly 21% of the fund down to somewhere between 12 and 16%. Companies like Halliburton and Valero may be removed, added just last year, now screened out because their prices rose while their dividend yields compressed.
Financials are expected to grow, with names like Johnson & Johnson, Blackstone, and Progressive potentially entering the fund. Now, here is the myth. The myth is that when a stock gets cut from SCHD, it means it failed. Here's the truth. In most cases, it means the stock price rose so much that the company's dividend yield fell below the screening threshold. Being removed from SCHD is often a sign of success, not failure. That is exactly what happened with Broadcom in 2024. Broadcom was the fund's largest holding. Then Broadcom's price surged. The AI boom sent it flying. Its yield fell below the cutoff. It was removed.
Broadcom then went up more than 100% in the following year, and SCHD's dividend still grew 12.2% that year. The fund wasn't broken. The fund was working exactly as designed. And here's the thing Tom didn't know when he was building that sell order. He was 11 days away from the ex-dividend date. If he had confirmed that sale, he would have missed the Q1 2026 distribution entirely. 4 years of contributions, and he was about to step off the train one stop before his paycheck arrived. So now you understand the mechanics, but there is still a number Tom hasn't looked at, the only number that actually measures whether his income is going up or down, and it's not the one he's been watching. The number that actually matters. Here is the most important thing I'm going to say in this entire video. Yield percentage and income dollars are not the same number. Yield equals your annual dividend divided by your share price. If the share price goes up while the dividend stays the same, your yield goes down, but your income doesn't change. You're actually wealthier. You just have a smaller percentage. This distinction is everything right now. A lot of investors are watching SCHD's yield compress as the share price has climbed in 2026, and they're reading that as a warning signal. It is not a warning signal. It is a math function. The number that actually measures your retirement income is the quarterly dollar amount per share. That's it. Watch that number. That is the only number that tells you the truth. And when you look at that number for SCHD's history, here's what you find. In 2022, the annual dividend per share grew 13.9%. In 2023, it grew 3.8%. In 2024, the year everyone said SCHD was broken after the Broadcom removal, it grew 12.2%. In 2025, it grew another 5.4%. 14 years of this fund. 14 consecutive years of dividend growth. Every reconstitution produced headlines. Every year, the income went up. The projected Q1 2026 dividend is approximately 27 cents per share, representing nearly 9% growth over the same quarter last year. In 14 years, every single investor who sold SCHD before a reconstitution missed a dividend increase. Every single one. SCHD doesn't just pay you dividends, it protects your dividends. Tom canceled the sell order, but what he found next when he actually ran the real numbers on his 900 shares surprised him in a way he wasn't expecting, and it had nothing to do with the reconstitution itself. The reconstitution was never the real story for Tom. The real story was something sitting quietly in his account structure, and it has been costing him money the entire time. Tom runs the numbers. Let's do the actual math on Tom's position. At the current SCHD dividend 2026 annual rate of roughly $1.05 per share, Tom's 900 shares earn approximately $943 per year, about $236 per quarter. In the base case, if the dividend grows around 8% this year, his annual income crosses $1,000 for the first time. Even in a hypothetical worst case, where the annual dividend fell to 93 cents per share, his quarterly check would drop by roughly $26. $26. That is the actual income impact Tom was considering selling his entire 4-year position to avoid. Now here are the numbers that matter at different share levels.
1,000 shares generates roughly $1,048 per year at today's dividend. 2,000 shares puts you at approximately $2,095. 5,000 shares gets you to about $5,240. And to reach the $1,000 per month milestone, $12,000 per year, you need approximately 11,450 shares, which at today's share price means a portfolio value of roughly $355,000 in SCHD. With DRIP enabled and the historical dividend growth rate, that goal moves closer every year, even without adding a single new dollar. Before I show you the tax angle, drop a comment right now. How many shares of SCHD do you currently hold, and what's your income target? I read every single one. Now, here's the number nobody told Tom about. SCHD dividends are qualified dividends, historically 100% qualified. That means they're taxed at preferential federal rates, 0% for married couples filing jointly with taxable income below $98,900 and 0% for single filers below $49,450. For retirees in the right income range, this is one of the most tax-efficient income streams available anywhere in a standard brokerage account.
And in 2026, it got even better. The One Big Beautiful Bill Act created a new $6,000 per person deduction for Americans aged 65 and older. For a married couple where both spouses are 65 or older, that's $12,000 in additional tax shelter on top of the existing standard deduction. A couple in that situation could potentially receive gross income well above $140,000, largely from qualified dividends, and owe zero federal income tax. Here's the myth most investors carry. If you're paying zero federal tax on your dividends, you're in great shape. Here's the truth. Most states don't honor the qualified dividend distinction. They tax these dividends as ordinary income. Tom lives in Ohio. Ohio taxes his dividends at 3.99%. He has never thought about it. On his $943 in annual dividend income, he's paying about $38 per year in state taxes that have never appeared on his radar. In California, that same income would cost over $125 in state tax. In New York, more still. This is completely invisible to most investors, and it's entirely fixable. And there is one more thing Tom hasn't looked at. His SCHD dividend income counts toward what the IRS calls provisional income, the formula that determines how much of his Social Security becomes taxable. At the thresholds where most retirees live, every additional dollar of dividend income can cause up to 85 cents of Social Security to become taxable. That creates effective marginal tax rates of 22 to 40% for retirees who are nominally sitting in the 12% bracket. You feel like you're in a low bracket. You aren't once this interaction kicks in. Here's what addresses both problems at once. Holding SCHD inside a Roth IRA. Roth distributions don't count toward provisional income. Full stop. The Social Security tax interaction disappears, and in most states with income taxes, Roth distributions are sheltered as well. Tom has been contributing to a taxable brokerage account for 4 years. He didn't know any of this. Going forward, that's the one structural change with the highest return. Tom now has a plan, not just for the reconstitution, but for the decade ahead. And what he decided to do next is the part that actually changes his retirement math. What Tom did next. Tom closed the sell order. He held his 900 shares. He received the Q1 2026 dividend, up nearly 9% from the same quarter a year ago, and then he did something he'd been putting off for 2 years. He opened a Roth IRA. His next $400 monthly contribution went there instead of the taxable account. He didn't move his existing shares. The capital gains tax on selling would have cost more than he'd save. But going forward, every new dollar of SCHD he buys will grow inside a structure that protects the income from both state taxation and the Social Security tax interaction. He didn't need a bigger position. He needed a smarter structure. And once you see that distinction,
You can't unsee it. Here's what I want you to take from Tom's story. First, know what you actually own. SCHD is not a single stock that can disappoint you. It is a rules-based system with 14 years of unbroken dividend growth. The reconstitution is the system doing its job, not the system breaking down. This is exactly the kind of thing that smart, prepared investors understand before everyone else does. Second, measure the right number. The quarterly dollar amount per share is your income, not the yield percentage. Find that number in your account. Track it quarterly. That one number tells you whether your retirement income is growing or shrinking. Everything else is noise. Third, check your account structure. If you hold SCHD in a taxable brokerage account and you receive Social Security, speak with a qualified tax professional about whether directing future contributions into a Roth IRA meaningfully reduces your effective tax rate on dividend income. For some investors, that one change produces more annual benefit than adding hundreds of additional shares. Income is not what you receive. Income is what you keep and can count on. If this video helped you see SCHD differently, hit subscribe and turn on notifications. I'm dropping a follow-up video right after March 23rd that will show the actual confirmed reconstitution changes, the real impact on the dividend, and exactly what it means for your income. You do not want to miss that one.